Hello, friends. Welcome to another episode of Peaceful Investing. In our last discussion, we talked about Nifty Indices and we looked at Nifty 500 and then strategy indices on Nifty 500, Nifty 500 momentum, Nifty 500 quality, Nifty 500 low vol, and Nifty 500 value 50. And we did our analysis. Today, what we are going to do is we are going to look at all the strategy indices which are published by Nifty, and we are going to compare their performance across last 20 years or more. All right. So this would give us in a way that if we are doing passive investing, which strategy indices from Nifty we should invest in, or which are top performers in those. Are they offering any good returns? What is their risk profile? All right. Before we begin, there's a disclaimer that this content is purely for educational and informational purposes. This is not at all our investment recommendation. Please do your own research before making any investment decisions. On that note, let's begin. If you look on your screen, we have uh, we have taken around 27 indices over here, and 25 of them are Nifty strategy indices, and along with that, we have taken Nifty 500 and Nifty 50 as well in our analysis. So all of them have been analyzed. We'll come to the summary picture in a moment. Let's look at what we have done. Okay. So what we have done over here is, I will take example of one of the indices. Let's take example of Nifty 50. All right. So what we have done over here is we have downloaded data from 1st April 2005 for each of these indices from 1st April 2005 to 4th July 2005, 25. This is total return index for each of these indices, and what it does is it reinvests whatever dividends are given by the constituents of these indexes. They have been reinvested. So it is the growth option. If you're talking about the mutual fund, it is the growth option. So this takes care of the dividends as well. Okay. Then we have calculated daily returns. So 4th of April, what return it offered, 5th of April, what return this index offered, so on and so forth. Okay. Also, along with it, we have computed maximum drawdown as well. Maximum drawdown is, it is the number which says if you would have invested 100 rupees in this index, what minimum value, what maximum loss you would have faced on it at any point of time. Okay. Most of these indices faced maximum loss during the 2008 global financial crisis. So one point to be noted here is, if you are comparing these indices, these maximum drawdowns, with any of the mutual funds or any of the uh, other investment strategies, you should compare and see for it that they also take into account maximum drawdown from 2008, so that you have the data from 2008 for them, because COVID also was a crisis, but the markets didn't went down as sharp as they went down in global financial crisis. Okay, so we have calculated maximum drawdown also over here, maximum loss that can happen. Okay, if we look at Nifty in the last 20 years or so, it has given CAGR returns of 15% with a volatility of 21%, and maximum drawdown has been minus 59%. So that means if you would have invested 100 rupees or a crore, if you would have invested a crore, it would have gone down to 41 lakhs at some point of time. Okay. Now let's look at the rolling returns. This is the best metrics, best uh, data point which you can look, especially over long term, which you can use to compare across funds. Okay, across strategies, across funds, across indices. Okay, so let's look at the 10-year, and especially over the longer term. Let's look at the 10-year rolling return of Nifty 50. It comes out to be 12%. Similarly, we have computed, this is average rolling return. So if you would have invested, someone would have invested on 1st April, then after 10 years, what the return would be. Then if somebody would have invested on 4th April, what after 10 years, what the return would be. And for similarly, for each and every date, we have calculated return for 10 years. And we took the average of all these returns. Okay. So this is the best metrics, best data point, which can give you how the index does over different durations. Not just 10 years, we have calculated this data points for 1, 3, 5 and 7 years as well. So if you see over long term, 3, 5, 7 and 10 years, Nifty provides close to 12 to 13% average rolling returns. Okay, 1 year return may vary because 1 year returns are very volatile. But what matters is this volatility number actually reflects on these minimum and maximum values, how far varied these returns are. So for 1 year, minimum return was minus 57%, probably at the time of global financial crisis. And then maximum returns in 1 year have been 106% as well. So let's look at the minimum returns, because this is what matters to us most, right? So if you have invested in Nifty 50 and there was a period, if you have been so unlucky that you invested at some point of time that you got the minimum 3-year return, then that would have been minus 5%. Forget about FD rates, it is not even positive. Your principal would have reduced. And then 5 years, minus 1%. This would have even pinched more, because 5 years standing over there and not even getting FD returns, not even getting positive returns, forget about FD returns, and this period would have pinched even more. 7 years, just 5% returns. Okay, but over the longer period, even there was a 10-year period in which it has given 5% returns. So that thing is reflected by the volatility over here. Similarly, we have calculated the SIP returns as well. So if you have invested 10,000 monthly in Nifty 50 and you would have done that on first business day of every month that you were investing 10,000, around this period of 20 years or so, 20 years and more, you would have got XIRR of 13%. And if you want to check out the principal sum which you would have got is, you would have got 1 crore 11 lakhs 44,336. Okay, this comes at, so your 10,000 monthly SIP, effectively 24 lakhs or so, somewhere around 24 lakhs, slightly more than 24 lakhs, would have become 1 crore 11 lakhs, close to that. Okay, so same analysis we have done for Nifty 500 as well. Again, 15% CAGR, slightly less volatility, higher drawdown as compared to Nifty 50, slightly higher 10-year rolling returns, 13%, and SIP returns of 14%, and corpus at the end of doing SIP for 20 years and few months would have been 1 crore 23 lakhs. Okay, so we have done this analysis. You can go through the sheet, go through this Excel. I'll attach it in description. Please check it out over there. We have done this analysis. For all these indices, Nifty indices. So if you look at this page, summary page, you can see uh, for all the indices we have mentioned CAGR over here, volatility, maximum drawdown, 1 year, 3 year, 5 year, 7 year, 10-year rolling return, and we have calculated Sharpe ratio and Romad ratio. Sharpe ratio and Roman ratio. Let me explain very quickly what is Sharpe ratio and Roman ratio. Sharpe ratio is CAGR returns of this period divided by the volatility of the same period. So that is column B divided by column C. Okay. Romad ratio is CAGR returns of this period divided by the maximum drawdown basis index phase. So this is returns over maximum drawdown. That's what it stands for. So if we look at over here, this matrix shows, see, the numbers in dark green are showcasing things which are on the good side, and as the strength of the color fades, the goodness of the numbers reduce. So CAGR, if it is 21 to 21 or above, it is marked in dark green. If it is 18, 19, 20, it is marked in a tad lower shade of green. And then for the tad lower shade of green, we have rest of the returns marked. Similar thing we have done in volatility, but some of the indices for which the volatility is very high, like 24, 25, and 20, 24 and above, we have marked it in red. And then we have uh, looked at the drawdowns as well. So drawdowns around 60% or below are kept as good performing drawdowns, and above that it is marked in red. Drawdowns above 70 have been marked in dark red. Okay, so let's look at these indices. Let me give you a comparison. So if you look at Nifty 50, Nifty 500, the broad market, large cap and broad market index, the 10-year returns are 10-year average returns are 12 and 13%. The Sharpe ratio is 0.69 and 0.73, and maximum drawdown is close to 60% for both of them. Okay, little higher, little lower, but close to 60%. These strategy indices, if you look at the 10-year returns, we have many strategy indices which have 10-year returns 19, 21, 21, 23, 21, 20, 21. These indices with a much lower maximum drawdown and much lower volatility as well. So 48%, 47%, 49%, 49%, 54%. These numbers are much lower than Nifty 50 and Nifty 500 maximum drawdowns. And so is the case for volatility as well. So Nifty 50 and Nifty 500 volatility is 20 and 21%. We have here more returns, more 10-year rolling returns or CAG returns, along with low volatility of 17%, 19%. Okay, 16%, 17%, 16%. And with lower drawdowns and better return. So that means strategy indices work. Hmm? So let's do now. There are so many strategy indices. Which ones we should invest in? So let's look at these. Let's do one thing. We pick up those indices. We filter out them. We pick up those indices which have Sharpe ratio greater than 1. Okay, greater than or equal to 1. So I apply that filter right over here in front of you. These blue, the indices which are highlighted in blue, they are started in 2009. I mentioned this time period over here. So given the fact that they started in 2009, I have not considered them in comparison with these indices, other indices which have started in 1st April 2005. So even then we have many options to consider over here. So based on Sharpe ratio, the best performer is Nifty 500 multi-factor MQVLV 50. This is a recently launched index. CAGR of 21%, volatility of 17%, maximum drawdown of 54%, much less as compared to other indices, and 10-year rolling returns of 19%. Highest Sharpe ratio of 1.19 and Romad ratio of 39%, which is highest again. So we have, though we have sorted by Sharpe ratio, the Romad is highest for this index. So if you see, all of the columns are cells are highlighted in green or a tad lower shade of green over here. So this is probably one of the best investment options. But yes, there are options which are offering higher returns than 10-year rolling returns of 19%. So if anybody wants to take up that, they can take up that, but that does come at a higher volatility and higher maximum drawdown. So then we have, this is a all cap index because it invests across, it picks up 50 stocks based on momentum, quality, value, and volatility from Nifty 500. So this is an all cap stock. Okay. Similarly, we have Nifty 500. This next index is Nifty 500 multi cap momentum quality 50, which is a again an all cap index. Okay, with CAGR returns of 22%, higher than that. Volatility higher, 19%. Maximum drawdown higher than the above option. Uh, instead of minus 54, it is in related comparison to minus 54, it is higher on minus 60% higher side, and 10-year returns 2% better than the Nifty 500 multi-factor NQVLV 50. Okay, and again, this has though we have started on Sharpe ratio, we have 37% ROMAT ratio. Again, one of the high numbers over here. Okay, on this whole column. Similarly, we have Nifty mid small cap 400 momentum quality. So if you see, momentum and quality are three repetitive factors in all these indices. But in this index, though the returns are higher, the maximum drawdown is minus 68%. Okay, so that's why the ROMAT ratio is only 34. And the next index, which doesn't have the quality factor at all, so the maximum, though the returns are 24% and rolling returns are highest 23%. This is Nifty mid cap 150, which is a mid cap which invests across 50 stocks from the top 50 stocks based on momentum factor from mid cap 150 space. So this can go in for your mid cap selection, has a maximum drawdown of 73%. Okay. If you look at the low volatility stocks, next we have in line all the low volatility variants, and see they have come almost together. Okay, so the CAG returns are 18-19%. The volatility numbers are 16-17%, lower than anything which we have seen above. And then we have drawdowns, which are again less than anything which we have seen above. Okay, but similarly, CAGR returns are also, or 10-year rolling returns are also on the lower side. But if you see, there are shoots, green shoots over here. So Nifty Alpha low volatility 30 has 10-year rolling returns of 19%, CAGR returns of 19%, highest among them, and drawdown of minus 57%. Okay, then Alpha quality low volatility 30 has CAGR returns of 18% and drawdowns of only minus 49%. Okay, then if somebody wants to take very high risk, they can, there are small and these are across, if you see these alpha, these low volatility versions like alpha low volatility 30 and alpha quality low volatility 30, they are across large and mid cap space. Okay, so what we can do is, let's ignore the, let's take up returns higher than 18%. Okay, let's leave out 15, 16, 17% returns. Okay, then we are left with just this much space. Okay, and across, so then we have small cap space, small cap momentum quality, which has again very though high CAGR and high rolling returns, has a maximum drawdown of 72%. Again, I would like to specify, if you are comparing these performances, these maximum drawdowns and these volatility numbers with any of the other investment strategies or mutual funds, please ensure that they are taking into account, while reporting those numbers, they have taken into account 2008 financial crisis as well, because that's the period of maximum volatility and maximum drawdown. All right, in the last 20 years. So time to time period, that's how only we'll be able to do apples to apples comparison, because this data is from 1st April 2005. to 4th July 25. Okay, so you have many options here: all cap options, few small cap options, couple of mid cap options, couple of large and mid options, and then mid and small options as well. Okay, so this is all about the performance of the Nifty strategy indices. Again, this is not an investment advice. This is not a recommendation. This is just for educational and information purpose. Okay. Next, please let me know in your comments if you would like me to compare these passive investment strategies with active mutual funds. We can do that as well. Thank you very much for your time. See you in the next episode. Thanks. Have a good day ahead.